I've been trading for 26 years now. I didn't go to university. I don't have any formal qualifications as such. And I first got into it, I had no idea what I wanted to do when I left school, none whatsoever. And I was working at a stockbroking firm called Potter Partners, which is one of the very elite kind of broking firms back then in the mid-80s. And I was a clerk in the commodities area, just pushing paper, nothing else. And I walked past the private client advisory desk one day, and there was a gentleman and he had this chart paper, and he was plotting a chart, and he had these moving average lines on the chart. And I stopped and I said, "What's that?" And he said, "Well, when the green line crosses the red line, you buy, and when it crosses back down, you sell." And I'm looking at it and I could see the trends in the market, and it just made sense. And by that afternoon I went down to the local stationery shop and bought some graph paper and bought the pens, and I started plotting. And I could just see how you could make the money from the trends. And that's how I started trading. I was trading within a week, and I was trading the share price index futures, which when you're 18 years of age is a bit of a dangerous proposition. And that's how I started trading. I think the best piece of advice I can offer is find something that suits you. The big problem that new traders have today is there's so much information out there. What appeals to me may not appeal to you. So there's two important things. First of all, you have to find something that suits you. Usually that's something that takes your eye straight away. So for example, with me, although it was the first trading thing I'd ever kind of see, it made intuitive sense to see those moving averages and see the trends. For you, it might be something different. It might be fundamental analysis, it might be value investing, it might be anything. Whatever appeals to you, usually the first thing that hits you, that's generally the way to go. That's my first piece of advice. My second is don't get caught up in what's called the beginner's cycle. The beginner's cycle comes about because most people feel there's some kind of secret that I know that they don't know. So, for example, they might come to me and we might have a bad run, which is going to happen to everybody. But what will happen is, say that bad run is 2 months long, and after 1 month this person goes, "No, you don't know what you're talking about." And then they go off and try and do another course, and then another course, and another course. So one of the things I tend to ask audiences is, how many trading books do you own? Invariably, people own 5, 10, 15, 50. I know people that own hundreds. If you own hundreds of trading books, or even if you own multiple trading books, you're looking in the wrong place. You're not grasping what profitable trading is all about. Profitable trading is simply about creating a mathematical expectancy. That's all it is. How you get to that expectancy is about your personality. The analogy I like to use is driving a car. At the end of the day, they do the same thing. They go from A to B. But your personality, your circumstances, everything about you dictates what kind of car you drive. Same with me. I have children, I need to lug things around, so I drive a different kind of a car. So it's the same with trading, investing. There's no right way, okay? It's all about having something that suits your personality, because if it doesn't suit your personality, you won't be able to do it in the future. And it doesn't matter how good the strategy is. If it doesn't sit right with you, you won't be able to do it. So understanding that all you need to be successful is a positive mathematical expectation, and once you grasp that, everything else is just noise, and then it's just a matter of doing something to get there. And everyone is different. You know, as I said, in my book I talk about momentum investing. It's just one way, not the only way. So it started off as a research product, doing technical research that could be included with fundamental research. So a lot of our clients, for example, receive research from their brokers, and it might say BHP is a great value stock, buy BHP. So what we wanted to do is kind of put a bit of a timing overlay and say, yeah, look, we really like BHP, but we think you'll be able to buy it at a better price. So maybe buy some now, wait for a better price to buy the rest of it. So that's where it started, and from there it's kind of morphed, and we've introduced a lot of other strategies, trading strategies, active investment strategies, and some of those have become very, very popular for people managing their super funds. Some of our strategies operate in global commodity markets, FX, US shares, all that kind of stuff. So we've grown over the years. I am purely a momentum investor. I use computers, okay, so it's quantitative. There's no qualitative metrics. I don't look at balance sheets, I don't look at management, I don't take an opinion on what the economy is going to do. My sole philosophy is you are judged solely on where you buy an asset and where you sell it. Why you do that is beside the point. The tax department don't ask you if you bought BHP at an undervalued price. They don't care. All they care about is what did you buy it at and what did you sell it at. That's all that matters. So that's because we are judged solely by price, effectively, then to me that's the most important thing. So what we do is we write computer models. Now obviously the big trend at the moment is computer models is high frequency trading. We don't do that. We're looking for trends and we ride the trends. The markets have to trend, they can't not trend. All we have to do is jump on that trend and ride that trend, and when it turns we hop off. That's all we do. And the analogy, let's use an analogy as I've used in the book of a hitchhiker. So say for example we're here at the uni and let's say we want to go to Canberra. The first thing we're going to do is we're going to go and stand out on the highway in the southbound lane. We're not going to stand in the northbound lane. Chances are cars going north aren't going to Canberra. Chances are that cars going south might be going to Canberra or in that general direction. When a car stops to pick us up as a hitchhiker, we don't know which car is going to stop. We know if we stand there long enough, a car will stop. The next thing we know, if a car stops, which it will, we don't know how far it's going to take us. It might take us down to the Shire, it might take us down to Wollongong, it might take us all the way to Canberra. We know it won't take us to Newcastle. So we're going in the right direction and we're taking that ride as far as it will go. So when we get told we're in that car and the car says, okay, I have to turn off here to Wollongong, you hop off the ride and you wait for another one to keep going to Canberra. And that's all we're doing. So the need to predict and forecast and quantify is not necessary for what we do. And we create our positive expectancy, our profitability, by riding those trends when they come along. And to give you a very good example, last year, Iluka, we bought Iluka at sub $4 and we rode it all the way to $15.50. Okay? Now at $4, the average broker recommendation or valuation was $5. No one was saying it's 15. And so as the stock went up, their valuations went up. Now when the stock got to $18, which was just peak, the average broker recommendation or the average broker valuation was $24. It went straight from 18 down to 12 and we got out, never been to 24. It might get there eventually, but for the last year it hasn't even been close. So we got out at 15, so we rode it up, it turned and we hopped off the ride, and that's all we do. So 90% of what I do is exactly that, on different time frames. We do it on a short-term time frame, but my main portfolios are on the longer-term time frame. In terms of time specifically, our average hold period would be about 8 months. So it's not like we're holding for years, we're just taking those rides, hopping off. And the other important thing that we do that most fund managers don't do is that we will go 100% to cash. In 2008, we were in cash by June. We sat in cash all the way through to March 2009. And that's where most of the damage was done. I think we lost about 13% in 2008. Most fund managers lost anywhere between 35 and 50%. So we play a good defence. That is, we try not to lose money when the market is going down, simply by staying in cash. And it's not a prediction that the market's going to go down. It either is or it isn't. And if it starts to go down, we cash out. As simple as that. So I didn't know that late 2008 and early 2009 the market was going to fall into an abyss like that. I didn't know, I didn't predict. It just happened to be that way. It could have turned around and gone back again. So if it does turn around and go back again like it does in 2009, we just hop back on board again. Again, it's just catching the ride. And 2009, we didn't know 2009 was going to be a bumper year. Okay? It just happened to be that it was. And because we don't use any emotion in our decision-making process, we didn't sit there in early 2009 saying, oh, the world's going to end, you never want to buy stocks again. A lot of people were in that position because they lost so much money. But we had only lost 13%. We're in a much better, stronger psychological position. And because we just go with the flow of the market started going up, we hopped on for the ride. And that's all we do. So it's computer driven. It's not high frequency. We'd only do about 30 transactions a year on average for the main portfolios. And that's perfect for people managing their super funds and managing their capitals. They can go and have their day job, do their day job. They don't have to sit in front of a screen all day and watch prices tick over. So it doesn't take very long each day. I'm not sure that our trading style is different. It's not considered typical. I'm not sure what they teach in universities these days, but I'm pretty sure they wouldn't teach a great deal about what I do. There's academic papers on momentum investing, certainly a lot more today than what there was even 5 years ago. But what we do is still considered very fringe. It's not really the done thing. What we do is, it's not about picking stocks, okay? People are taught to pick the right stock, pick the right company. This is a good company, buy it, and it'll be good to you over the longer term. We don't do that. We're not interested in what the company does. I don't even know what a lot of the companies do. I just know that the price is going up, and if the price keeps going up, that's how I make money, and that's all I need to know. So trend following or momentum investing isn't anything new, but it's just not accepted yet. And the analogy I use in the book, right at the very beginning, is the Fosbury flop. Dick Fosbury, back in 1963, high jumper, couldn't get over the bar, and he did something no one else has ever seen or done before. He went over the bar backwards. Now everybody criticised him, and people were saying he was cheating, he was doing things that he shouldn't be doing. Doctors were saying a whole generation of athletes were going to break their necks. This is a tragedy, this is terrible. 3 years later, he won gold at the Mexico Olympics. Within 4 years of him winning gold, 90% of athletes used his style. And today, 94% of all medals won in the high jump use his style. So it takes time for a fringe type strategy to come online. And the longer it takes, the better it is for me. So it is a little bit different, but it's being used all the way around the world. There's people that have been doing this for 30, 40 years. You just never hear of them though. My main concerns are twofold. Controlling risk is number one. That's what we do that the average fund manager really doesn't do. They look at returns. That's all that matters to them. But as we've seen in 2008, the average person, returns are fine, but they can't stomach losing 30, 40, 50% of their capital. There's a lot of retirees out there who can't retire now because they lost so much money. So number one, controlling risk. That is it. In fact, risk is actually the only thing you can control. You can't control what you feel the valuation of a company is going to be. You can, last night on the show, there was a person rung in, this share was trading at 25 cents, and he was saying that it was valued at $2. You may as well value it at $50. It doesn't matter. Whether it gets there or not is the other issue. You can't control, you can't make it go to $50 or $2 or whatever it may be. What you can do is control how much you're willing to lose. That's the only thing you can control. So that's number one. Number two is controlling emotions. Emotions are pretty well why so many people fail. Investing and trading is hard. It's hard because psychologically you do everything opposite to what you're supposed to do. And I tell a lot of my clients, a lot of my students, the first thing that comes into your mind is often the wrong thing to do. Okay? So controlling the mind, and I think the big difference between a professional like me and an amateur is my psychological fortitude, the ability to be patient. People want things to happen. They want it to happen now. They don't believe that they could invest money in a strategy for a year and actually lose money. Yet they're willing to accept that that will happen if you buy a house. It makes no sense whatsoever. So there is a disconnect in reality there for a lot of people. The Steve Jobs, reality distortion field, I think he calls it, or something like that. So minding the mind emotionally it can't be taught either, by the way. It just has to be something that you have to be aware of and learn and put it to use over time. The markets haven't changed. People are out there saying it's all different now. The only similarity in the markets is change itself. That is it. So people told me a few years ago that the strategies I use will never work again. There was a famous quote that if anyone uses a strategy or used a strategy prior to 2009, it won't work again. That's garbage. Markets can't not trend. Okay, they have to trend. To say that a market won't trend says that all businesses listed publicly are priced fair value and do not move. But it doesn't take into account human emotion, which swings prices backwards and forwards. So the markets always have to trend, and therefore there's no way a momentum type trend following strategy like mine can't not work. It has to work. It will go through periods of time where it's out of sync, where the market doesn't trend. It doesn't mean the strategy is broken, okay? It just means that the market's not trending, you sit through it, and one day it will trend again. So during that period of time, you have to be patient. And the last couple of years have been a little bit like that. You know, the first 8 months of 2010, for example, the market went sideways and my account didn't move. Went up a little bit, down a little bit, up a little bit, down a bit, for 8 months. Now, the average person in the street will say your strategy doesn't work. And then in the last 3 months, I made 24%. So I finished the year up 21%. But what you don't read about is I made it all in 3 months. And for 8 months, I sat there patiently waiting and waiting. So the markets haven't changed. There are certain aspects of the market that change on different time frames. So for example, if you're a scalper, if you want to sit in front of a screen and scalp day trade all day, you will find it's a lot tougher now because a high frequency trader or high frequency systems have changed the daily structure of the market, if you like. There's a lot more noise, a lot more volatility, and that can make it a lot harder. But from my perspective, it doesn't change anything. They can't change macro trends or bigger trends. Everyone makes mistakes. I guess there's two qualifications. There's two qualifications, mistakes and losses. They're different things. I'll have losses. They're not mistakes. Okay? Since 2006, only 50% of my trades have been profitable. Now, the average man in the street will say, well, your strategy is not very good. But mathematically, if on those losses I only lose $1, but on the profits I make $4, I'm very, very profitable. And that's basically the way it is. So it's not about being right or wrong. It's about how much you make when you make and how much you lose when you lose. So a loss is not a mistake. If I follow my strategy as it's designed and it culminates in a loss, it's not a mistake. That's part and parcel of travelling the journey. In terms of mistakes, yes, I've made mistakes. I've made one this year. I was short natural gas. In fact, it was mid last year, I think June or July last year, I shorted natural gas and I just changed brokers. And I wasn't used to this new brokers platform, and there was a little bit of a mistake with my understanding of what the platform did. It was purely my mistake. But I got frustrated and said, okay, forget natural gas, I'll just let that go. I won't continue with that position. And of course, natural gas just has been going down for about 12 months. So I've been sitting there every single day, counting up all these profits that I should be seeing that I'm not seeing. Now, the problem with that is obviously it's profits that I don't have, but those profits have to offset losses that I actually do have. And that's the problem. So that was a mistake. So I've been doing this 26 years and you make a silly mistake like that. Other mistakes, big mistakes I've made, for example, remember many, many years ago, I bought S&P 100 options instead of S&P 500 options, the S&P 100 options expired worthless and the S&P 500 options went through the roof. So I lost $80,000 in a matter of minutes just because I bought the S&P 100 instead of S&P 500. You'd think it's kind of similar stuff, but it had nothing to do with it. So, I mean, that was a long time ago, but you make those mistakes and you've got to learn. 1987, I played a dangerous game in 1987. I was young, I was stupid, and I was earning $12,000 a year, and I had about $200,000 worth of stock completely borrowed, and of course the market dropped 50%. So, you know, I lost many times my annual salary in one day. But, you know, it's a matter of saying, okay, I made a mistake. It's not going to take me out of the game. It's certainly, a situation like that's going to hurt, but being young enough, it's not a problem. Making those kind of mistakes at my age now, you don't want to do that. But, you know, making a mistake, you've got to learn from it. If you keep making the same mistake, then you've got some issues that you've got to get sorted out. It means absolutely nothing. I have losses every day. You know, there's some of my US positions last night went against me. A loss, a loss is part of it. It's like you wanting to drive from the university down to Cronulla and you don't want to stop at a traffic light. Well, that's part of it, isn't it? It's going to happen. If you don't want to stop at a traffic light, well, best you go and buy a helicopter or something like that. So people who are disappointed with a loss or disappointed about anything, their disappointment comes because they have an expectation. So if you have no expectation, then you will never be disappointed. So a loss will happen. If you don't think a loss is going to happen, then you're kidding yourself. If you get told, no, we don't have losses, then you're being lied to. If you get told that you'll be profitable every single day of the week, well, you're being lied to. It's going to happen. So remove any expectation and then you won't have any disappointment. Investors and traders, there's, you know, as I said, it's a personality thing. I think if you want to understand the kinds of things that I do, rather than Warren Buffett does, or Roger Montgomery does, or so, it's a different set of books. A couple of good books I'd recommend. Trade Your Way to Financial Freedom by Van Tharp. Teaches you about position sizing, risk management, and all that kind of stuff. Very, very important. So that's a good one. If you want to learn about trading in general, something like Dr. Alexander's Elder, Trading for a Living. Very simple, straight down the line, good for newbies, and it gives you a good foundation. But as I said earlier on, what you don't want to do is go and buy 100 books, because everyone who writes a book, that's their own personality coming out. So all you're doing is relating to their personality, and you've got to find something that suits yourself. The first book I wrote was Everyday Traders. When was that? 2001, 2002, Everyday Traders. It actually interviews professional traders. A lot of these guys are prop traders. A lot of these guys today are still prop traders, managing their own money, managing other people's money. And it's a pure interview book. It's like Market Wizards that was written back in the 80s. But this one was the first of its type in Australia. And it's interviewing Australian traders who trade futures, interest rates, trade stocks. And it's just their experiences, what they do on a day-to-day basis, how they go about it. The second book I wrote was 2006 or 2007 called Adaptive Analysis. That's a book a lot on discretionary type trading. My philosophy is about risk management, position sizing, positive expectancy, and then looking at the market, how can I find an opportunity here? And again, I stress it's all about looking at price action rather than fundamentals. And my last book, which was just released last month, Unholy Grails, is pretty well everything that I'm about. It's systematic, quantifiable momentum investing. So again, we lay the foundation, the philosophy behind it all. Then what we do is we actually put 8 strategies to the test. We put them through the computer and we have a look how they've performed, can they be made better, can we do this, tweak them, whatever. And then we look at proof of concept. Very important. Everybody has a theory. Theories are great, but where's the evidence? Where's the proof? So that's what we put forward in this book, actual proof of evidence of this strategy running for the last 6 years in real time. And then the book ends with interviews with 4 individuals who use momentum investing very, very profitably. 2 of these individuals have never worked in the business. They're completely outside. One owns a bus company, the other owns a horticulture company. So they have nothing to do with the financial markets, they've never worked there, and they've worked it out for themselves, and they now run very, very large accounts. But it goes through their journey, how they got there, the mistakes they made, the things they went and did, and where they are today. Something that suits you is important. Be patient. Okay, you've got to be realistic. This is not a sprint. This is a long-term event, and especially with uni students, I'd love to know what I know now and be your age again, because when I was your age I had no patience. I didn't have a 20-year time frame, but with a strategy like we do, you start at your age, you don't need a lot of money, and you use the power of compounding on that strategy. You know, since 2006, we've made a compounded return of about 18%. Now you multiply that out, and you start in your early 20s, and by the time you're 40, you won't have to work again. But do you think I can get my kids to look at it like that? No. But patience. You've got to take the long-term view. It's not a sprint. Go and do what you love to do. Okay? If you're doing law or economics and you want to go and do that as a career, go and do that. But you can operate this kind of strategy on the sideline. It literally takes me 5 minutes each evening to do it. So go and have your career and put money into the strategy and let that work in the background and do it for 15 or 20 years, and away you go. Better than buy and hold.